All right, welcome. When you look at a stock price, it's so easy to think that's the whole story, right? But what if I told you there's a much deeper, much more insightful way to figure out what a company is really worth? Today, we're going to pull back the curtain and see how the pros do it. Let's get right into it. So let me just ask you this straight up. How much is a company really worth? I mean, it seems like a super simple question, doesn't it? But that number you see flashing on your screen, well, it often hides a way more interesting and frankly, a much more important story. And that's why we've got to look beyond just the stock price. You've probably heard of the PE ratio, right? The price to earnings ratio. It's everywhere. And look, it's fine for a quick glance, but it's got some pretty major blind spots that can seriously lead you down the wrong path. You can kind of see the two approaches here. On one hand, you have the simple view, the PE ratio. It just looks at the stock price and the profit. It's like judging a book by its cover. But then you have the professional view, EV/EBITDA. This gives you a complete 360-degree picture of the entire business. It's the tool that lets you compare completely different companies, even ones that seem like apples and oranges. Okay, so let's dig into the pros valuation tool itself, EV/EBITDA. Seriously, think of this thing as your financial X-ray vision. It lets you look right through the surface-level numbers and see the real health of the company's core. And to make this super simple, let's just forget about stock markets and multi-billion-dollar companies for a second. Instead, I want you to imagine you're just buying a small local bakery. This little example, it's the key to understanding this entire concept. Trust me. Okay, let's break it down. Step 1, the sticker price. You agree to pay 500 rupees for the bakery. Easy. But then, surprise, the owner says, oh, by the way, there's a 300 rupee loan on the oven that you have to take over. Suddenly, your cost just went up. But hold on, there's some good news. You find 100 rupees in cash in the register. And hey, that's yours now. So what's the real cost? It's not 500. It's the 500 sticker price plus the 300 in debt you took on minus the 100 in cash you got. That comes out to 700 rupees. And that, my friends, is the enterprise value. And this bakery example, it perfectly shows why the pros are obsessed with this metric. First, it's debt neutral. It means you can compare our bakery to another one that has way more or way less debt and still get a fair comparison. It gives you a pure operating focus, cutting through all the accounting noise. And most importantly, it gives you that true acquisition perspective. You know now what it would actually cost to buy the whole thing. 700 rupees, not just the 500 rupee sticker price. It's the value of the whole enterprise. All right, now that we've got the big idea down with our bakery, let's actually look at the anatomy of EV/EBITDA. Don't worry, we're just going to break this formula down into its simple, easy-to-understand parts. I promise it's way less scary than it sounds. So first up is enterprise value, or EV. This is the top part of our fraction. And just like with the bakery, it's the total, all-in price tag for the whole company. You start with the market cap. That's basically the stock price times all the shares. And then you adjust for its debt. And that adjustment is where net debt comes in. This is the secret sauce that makes this whole thing so much smarter. You take all the money the company has borrowed, its total debt, and then, and this is the key part, you subtract all the cash it has sitting around. It's the exact same thing we did with the bakery. Add the 300 rupee loan, but subtract the 100 in cash. It tells you the true financial weight a buyer has to carry. And finally, we get to the bottom part of the fraction, EBITDA. Yeah, I know, it's a mouthful. It stands for earnings before interest, taxes, depreciation, and amortization. But here's all you need to remember. This number shows you how much profit the company's actual business is making, before all the weird stuff like tax strategies or accounting rules can mess with the picture. It's the pure operational profit. Okay, theory is great and all, but let's put this thing to the test in the real world. We're going to grab our new tool and apply it to a real company, the food specialist Mrs. Bector's, and see exactly how an analyst would crunch these numbers. Okay, so let's put on our analyst hats for a minute. Here's the key data we've pulled from Mrs. Bector's. We've got the market cap, that's the sticker price, we've got their total debt, and right below it, the cash they have on hand. We'll use those to get our net debt. And finally, we have their TTM EBITDA. TTM just means trailing 12 months, so it's their core profit from the last year. All the pieces are here.
So let's do the math just like we did for our little bakery. First, we take that market cap, the sticker price, remember, and we add the net debt that a buyer would have to take on. That gives us our enterprise value, a cool 8,813 crore rupees. That's the real price to buy the whole Mrs. Bechter's business, lock, stock, and barrel.
And now for the grand finale. We take that enterprise value we just found, and we divide it by the company's operating profit, that EBITDA of 287 crores. This is the moment of truth. This is going to tell us exactly how the market is valuing this company relative to its core earnings. And there we have it, 30.7x. This number, this multiple, this is the whole point. What it means is that the market is valuing the entire Mrs. Bechter's enterprise at about 30.7 times its annual operating profit. Now we have a powerful number we can use to compare it against its competitors or even against its own past performance to see if it's looking cheap or expensive. But wait, we're not quite done. Because a true professional knows that valuation isn't about finding one single magic number. Nope. It's about thinking in scenarios. Because, let's face it, the future is never 100% certain. And this quote right here just says it all. Single point estimates, that's for amateurs. The pros, they build scenarios. They look at a conservative case, a realistic case, and an optimistic case to create a whole range of possible values. This is where the science of numbers meets the art of investing. So, by playing with different assumptions about how fast the company might grow, we can project a range of potential target prices for the stock. As you can see here, we might have a conservative target, a more realistic one in the middle, and an optimistic one. This gives us a much richer, way more useful picture of the investment than just clinging to a single number. Now, it's super important to be honest about where EVE/EBITDA falls short. It's not a silver bullet. For one, it completely ignores CapEx, which is the real money a company has to spend to maintain its equipment. It's also not very useful for companies that are losing money. And you should always use it alongside other tools, like a DCF analysis or even the simple PE ratio. Remember, it's a powerful tool, but it's not the only tool in the shed.
So, I'll just leave you with this one thought. The next time you see a stock price on TV or online, are you going to take it at face value? Or are you going to pause and ask the pros question? Yeah, but what's the entire enterprise really worth? Thanks for tuning into this explainer. I'll see you on the next one.